This is the Bloomberg Surveillance Podcast. I'm Lisa Abramowitz, along with Tom Keene and Jonathan Farrow. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
Right now, I've been out a few days, but I really want to reset here on the American economy, and there's no one better to do that than Tiffany Wilding, economist at PIMCO. Tiffany, I'm going to go beyond the labor reports. We'll circle back to that. What is your real GDP growth for 2024?
Yeah, I mean, so we think that the good news from 2023, the resilience story, the 2.5% kind of above trend GDP growth, that's probably squarely behind us. The saying kind of goes, you can't go to heaven twice. And we think some of the factors that led to that, we're still some of these excess savings sloshing around from the pandemic and other supports. And, and those kinds of things under our estimation are going away next year. And when those things go away, what you're left with is still tight monetary policy. And obviously we have a Federal Reserve that is telling us they're going to remain on hold. So those policy drags are continuing to build. So overall, we think growth probably is closer to something, stagnant, whether it's slightly positive or slightly negative, I think is anyone's guess. But we're kind of a stagnant situation next year.
So are you basically saying that we're in heaven and that this is the Goldilocks and that you can't go there again? It's over?
Yeah, I mean, so we do think there's a lot of good news this year with the U.S. economy. There's a lot of surprising resilience in the growth numbers, of course, and some we think, the supply picture, as the Federal Reserve has also pointed out, has also helped that. But again, if you look to 2024, you have demand, which is potentially coming down, but some of the things that added to supply, like supply chain normalizations, we have a labor force participation rate for the prime age folks that are now, it's back to pre-pandemic levels. We're just not convinced maybe that you're going to get as much on the supply side next year. Now, of course, immigration has been a story here, and that's why we've also seen, the unemployment rate rise, because some of those labor market inflows aren't getting absorbed by just a strong labor demand. But again, overall, all of those signals kind of point to us of something that's closer to more stagnant economy.
Baked into this is this assumption that you're going to have higher yields for a longer period of time. You said what we're going to be left with is just tighter financial conditions. And yet it's unclear whether that's going to be the case. There have been a lot of people calling for pretty substantial rate cuts by the Fed, by the ECB, in response to inflation coming down significantly. Do you agree with a paradigm where oil prices stay lower than they have been and keep inflecting lower because of production, because of supply? You start to see a re-engagement of global trade, forget deglobalization, and you start to get more people come into the workforce. It's basically everyone that people use. It's the opposite of the "this time is different" narrative that we heard this year.
Yeah. Well, I mean, I'm not exactly sure in terms of labor market inflows, higher participation rates for that prime age cohort. I'm not sure that that's going to continue to increase. I do think there's some potential for immigration flows to stay high in 2024. That's been a story not only in the U.S. but across the developed markets. Obviously, elevated geopolitical risks and conflicts are contributing to that as well. But overall, I guess what we would say is that. The Federal Reserve has told us that they are still worried about the last mile problem on inflation. In order to really ensure that inflation's back to target, we think you do need to see some more labor market loosening.
Market is coming back here in equities, bonds, currencies, commodities, a little bit of adjustment off the claims, and we've come back in a little bit. I call it noodling as we stagger to tomorrow morning at 8:30. Tiffany, one of the great responsibilities you have is to stagger down the rows at PIMCO, tripping over the antique Monroe traders and looking at people's Bloomberg screens. And the 2-minute drill is, what is a short space going to do, the Jerome Schneider space, and what's it going to do in terms of the wall of money that's out there. That's off your remit. But your remit is, what are the economic conditions that make cash finally move? Can you come up with a scenario where cash finally moves?
Yeah, absolutely. I mean, I do think it's certainly this quote soft landing scenario, right? And I think that the fact that the Federal Reserve as well as other central banks have signaled that they're at the top of their cycle, along with this coinciding shock to term premiums, just made bond market valuations look really attractive. And as a result, those higher yields just didn't stay around that long, and you are starting to see cash, I think, come off the sidelines, go into the bond market. Now, I think there's a question around the equity market, riskier assets. I mean, certainly a soft landing will be helpful. But when we look at valuations, for equities, for example, we are more cautious. Equity risk premiums are still within their historical range. They're not pricing in a lot of recession risk in our view. And we don't think we're out of the water yet or out of the woods yet. There's still a lot of uncertainty here. And we just don't know that you're paid for it going out the risk spectrum.
The quality of a lower GDP reset off of the shock of what happened in 2003, 2020. Listen to me, I'm decades away. Lisa, help me here. 2023. To me, what's so important, Tiffany, is the productivity discussion of the last 90 days. Give us the PIMCO brief on the efficiencies of the American economy.
Yeah, well, I think if you look more, more broadly, there was a lot of noise around the productivity statistics during the pandemic because you had unproductive sectors that were effectively shut down. Then they reopened. And so there was kind of a mixed shift, if you will, in terms of economic output that impacted the productivity data. But if you look more broadly, it looks like it's on trend at a low level. And I would say that there is, probably good news in terms of the productivity outlook that's embedded in, AI and large language models and things like that. But if we look at research that, just kind of estimates how long it takes for those types of technologies to proliferate, obviously that time has come down, but it's not 2024. It's still likely a quote, secular horizon, so 3 to 5 year time horizon that you're really seeing the productivity gains from something like that. And the last thing I would just highlight is that, we saw PCs or the internet, it took, quite some time for us to actually see productivity gains in the 90s to come from that. So, at least from a 2024 perspective, we're not as convinced that you really start to see that in the data. But I think there's, room for encouragement on a secular time frame.
Just quickly, Tiffany, you seem to be pushing back against market expectations for rate cuts next year. Do you think that we will get rate cuts by the Fed? Do you think that they'll be in the first half? Or do you think that they're going to be squarely in the second half and not that many?
Yeah, well, I mean, look, I do think it depends. I mean, the real side of the economy, it does need to slow in our view. And it needs to slow, and you need to see a little bit more, loosening of the labor market, we think, in order for central banks to really feel confident that inflation is more sustainably at their target. And, looking at, I think there's definitely some still resilience in the economy, and we could see central banks lag, worried about that outcome. Powell has very clearly stated, that he wants to be a Volcker, and not a Burns. And so, we think they could be laggy in terms of when they start to cut. But nevertheless, obviously the market's going to price a balance of risks here, and the inflation data certainly has been good over the last couple of months.
Tiffany, thank you so much. Tiffany Wild with PIMCO. They manage bills, notes, and bonds out of Newport Beach, California.
I think David Bailey is doing what every other guest who's come on this program over the last 10 years does, trying to work out the first question that Tom's going to ask, because no one's got any
I got
idea.
two. It's a double barrel.
I hear it from guests all the time.
I thought he was going to ask me what the VIX was. That's why I was leaning over.
Okay. David Bailey, CIO and Head of Investments at Citi Global Wealth, with us in just a moment. Let's turn to the price action. Equities on the S&P 500 shaping up as follows, TK. Positive by 0.1%. Yields up 5 basis points, 4.1552 on a US 10-year.
Audible question to Balin. You worked with John Henry years ago, the owner of the Boston Red Sox. How in God's name does John Henry let Juan Soto go to the New York Yankees and not the Boston Red Sox?
And I won't answer that question, but tell me how it is that John Henry, as a trend follower, has won 3 World Series when the Yankees have only won 1 in that similar period of time.
Very nicely finessed.
Thank you very much.
Very good. Let's go to cash. I mentioned it to Bramo. It's in your review here, the mystery here of all this cash. And you talk about there's just too much cash out there. What do we do with our cash next year?
You've laid out, actually, an incredible introduction to what we're writing for this next year, which is called Slow Then Grow. And the idea is that you are going to see a slowing economy at the beginning of the year. A lot of the concerns that Lisa just talked about, actually could come to bear, right? Which is the economy slows down, but it does not crash. We do not have a recession. We do not have a V-shaped recovery. And because we don't have a clear signal to investors, they sit there in cash. $5.8 trillion worth of cash at this point in overnight funds. It's extraordinary. And yet, when you take a look at all the different parts of the economy, right, you take a look at the average stock in the U.S., hasn't done that well. 10 stocks have done incredibly well. Bond market's already started to move. Energy is down. You are seeing real signs that inflation is not an issue and that the Fed will hit their target of 2 to 2.5% by the end of the year. So if that's true, right, what you then need is a boost of earnings, right, in order to believe that all of this comes together. And this is where I think the story is being missed by the average investor, is that in the U.S. you're going to see ambient-like earnings up by probably 5% this year and then 8% in 2025. And that sets us up for a thing where, an opportunity where a balanced portfolio, right? You put your money in bonds and you put your money in stocks and you sit there and you're patient. And over the next 18 months, you can get yourself a 15 or 20% total return. Now you're giving me the skeptical look, Lisa, right?
I'm just interested.
Here's the interesting data point. In 1931 and in 1969, the last two times we had stock and bond markets down for an entire year, if you looked out just 2 years later, in each of those periods, a balanced portfolio, 60-40, was up more than 20%. And while that's not statistically significant, what's interesting is we've already had incredible negativity in the stock market and incredible negativity in the bond market this year.
Okay, and you point to Tom, but this to me is really a question of, can you bet on the grow before we get the slow?
Right. Well, the grow is already, the grow is the coming off of, it was
Pause.
good.
1 sec. Did you just make that up? Because that's great.
That was like a haiku.
Well, that's essentially what we're asking is, can you bet on the expansion before we get any kind of slowdown?
I love that. That's awesome.
Okay, so we have to answer the question.
No, please do.
That's okay. So let's take a look along real estate, right? Which has already been in a recession. We've had manufacturing already been in a recession. We've had parts of the parts of our economy like healthcare, right? Negative earnings for the first time in 15 years this last year. Lots of these parts of our economy, 40 or 50% of our sectors, are going to be having very positive earnings relative to 2023. And then the average stock, which has gone virtually nowhere this year, has the opportunity to rise. One of the things we put into our portfolios is the most boring investment we've added, which is S&P equal weight. If 10 stocks have done well, you want to own the other 490. So I just think that this is where people have sort of missed it, is that we haven't seen the overall market rise yet. And that's what 24 is going to be about in terms of earnings.
So the double-digit percentage point gain that you think we can get next year, that's at the equal weight and not the market cap weighted index?
That's right.
Okay.
That's right. And I think that's the opportunity, is this rising earnings, because you've had large portions of the U.S. economy are coming out of a recession now. Their inventories are down. They've got to rebuild. They're not hiring. Wage costs are coming down. It's not about a landing. That's the other thing. Everyone's talking about this hard landing, soft landing. Forget about it. We're now in the situation where we're now beginning a normalization of markets back to sort of where they were like 4 years ago, pre-pandemic conditions, and we're going to be coming out of this in a grow mode.
Are banks structured well for that moment?
Have bank structure or our client structure?
No, are banks structured, as in the equities, the bank equities that have struggled so much this year off the back of high yields?
I mean, I definitely believe that the normalization of the yield curve is going to definitely change valuations for banks as a segment. I think that's more of a 12 to 18 months trade than it is a long-term opportunity. I do think that banks are very undervalued at this point.
I guess I'm trying to understand this perfect scenario and how much oil plays into it as well, given the fact that has been one of the reasons we've seen this disinflation narrative get some legs. How much does that factor in that we're going to keep seeing suppressed valuations?
Right. So I don't think we expected oil to move down as quickly as it has, and I definitely think it's supply, like you said earlier in the program. What we have, I think, discounted is the fact that globalization is still a major disinflationary force. Import costs of goods coming into the U.S., both finished and unfinished goods, are negative 3.7% relative to last year. They are adding to the disinflation story. So between energy and import costs, you have this situation where you just don't have inflation on goods, and that, of course, translates into a better economic scenario. It seems like you're having trouble believing that that you could have a really good backdrop for markets.
No, what I
equities,
find
and debt.
fascinating is just how much the narrative has gotten it wrong. Everyone's talking about deglobalization, how that would lead to inflation. Oil prices would be higher because their production just wasn't capable of meeting demand as all of the transition happens. And all of a sudden, workers are going to cost more to do the jobs that need to get done. And what we're seeing is all of the exact opposite. Isn't that sort of remarkable?
It is remarkable. The hiring for the last 2 years has been surprising. We've hired more people with slower GDP growth in the U.S. than in history, and now that's coming the other side. And the Saudis and OPEC wanted to keep oil prices higher, right? But they were unable to do so. They were originally willing to cut back production. So there's a lot of things where people think they can control market. And just to add one more thing, expectations in China and Europe are so low that they can't help but contribute, I think, to the growth story sometime in 2024.
This was great. You two should get a podcast. I think it was
You do that all the
brilliant.
time here, podcast.
We can do another one. Why not? What should we call it? Hope and gloom?
Yeah.
Something like that.
Bad news, bad news.
Betting on
Bad
growth
news is
before
bad
slow.
news.
Something like that.
Well, we just call it slow then grow, or what was the other
We
phrase?
forget.
Okay, but it was good. It was something like
Slow
vicious
versus
something.
grow is awesome.
Well, that's
I've
his
got a
words.
lot of time for that.
That was the whole thing. I mean,
Love
that's
that.
the bet that we have going on here.
That's great. David, thank you. It's good to see you, and thanks
Good
for
to
sharing
see you.
your outlook with us as well.
My great pleasure.
David Belling, then, of Citi Global Wealth, looking ahead to next year.
Is the Fed put back? There's no better way to answer that question than speaking with a former Fed governor, Randy Kroszner, professor of economics at the University of Chicago, Booth School in Chicago, joining us now. Randy, do you believe in this idea that the Fed will cut rates aggressively next year simply in response to disinflation, even if it is not accompanied by weakness?
So if they've reached their goal of bringing inflation down to their 2% target, they'll be happy to bring rates down. But I don't think they're going to get to their target anytime soon.
I look, Governor Kroszner, and I know you had a recent meeting where the Booth School graduate, John Studzinski, and all of his work now at PIMCO as well. But what the John Studzinski world is about a global sense of we're all in this together. That's been the hallmark of his work for years. How linked now are our central banks to develop a constructive disinflationary trend?
I think that's right. I think you saw that once the Fed took off, raising rates fairly aggressively, the other major central banks in the world did the same, so that they kind of played from the same playbook because they were experiencing inflation in a similar way, which suggested that at least part of the inflation wasn't just due to what central banks were doing, but was also doing to some of these broader global supply chain factors. And we've seen inflation come down. We've seen them move down together. But the Fed is really the big player, and so
Right.
it tends to be that other central banks will follow what the Fed is doing. But of course, there's some discussion across the central banks. But the Fed's got to do what it's got to do for the U.S. economy.
If we are the big player, and I guess this is off the jobs report tomorrow, on the American exceptionalism of strong nominal GDP, better than good fiscal stimulus, we all know the story. But the answer is we're dealing with a technological excellence. Does the Fed pull that into their debate?
That's one of the debates about productivity. And because if you have high productivity growth, it's perfectly fine to have high wage growth and not have inflation. But if you have low productivity growth, you can't sustain high wage growth without there being inflation because the costs are going up relative to the outputs. And so that's one of the debates. Are we going to see productivity continue to be strong as we have over the last few quarters?
Is that the main reason, Randy, you don't think we're going to get to the Fed's target?
Oh, I think there are a whole variety of reasons. I think you've got expectations that never went up very much for inflation, I think, to the Fed's credit. So it never really lost credibility as the Fed did in the late 1970s, early 1980s. But I think it did lose a little bit, and people have kind of gotten used to asking for a little bit more in wages. And they also have to make up for having lost so much in real terms, inflation-adjusted terms, over the last couple of years. So I think there's going to be a catch-up in wages. I think nominal wage growth is going to be above the inflation rate, as it has been over the last few months. And that means at some point it'll be less exciting for firms to be hiring and holding workers. Then employment rate will move up. And as you know, I've mentioned before, I think we'll probably have a hard-ish landing. Not a hard landing, but hard-ish.
So if you talk about the nodes of inflation that are stickier, that are going to be concerning to the Fed, that aren't going to allow them to cut as aggressively as some people are currently pricing in, is it particularly the service sector? Is there an area of inflation that you're focused on to sort of signal what you're talking about?
I think the Fed is going to be laser focused, exactly as you said, on services, as well as on the key thing that will be driving services inflation, which will be wage growth, particularly wage growth relative to the inflation rate, which until recently, until really maybe 4 or 5 months ago, had been nominal wage growth was below the inflation rate, and now nominal wage growth has been above the inflation rate. It's great for workers because they're getting increase in real wages, but that means that firms are going to be a little more reluctant to hire.
Randy, are lower prices, if oil, inflationary or disinflationary?
Well, certainly for headline inflation, it's lower. It helps to lower the headline inflation rate. But as we know, the oil prices have gone up, gone down, gone up, down, down, and so the Fed kind of looks through that, and that's one of the reasons why they look at the core numbers that strip out the more volatile food and energy sectors.
Randy, you're one of our giants in financial economics. Where we are right now, is it out of the textbooks you learned from, or post-pandemic, is this all original?
Well, I wouldn't say it's all original, but it's at least a little bit unusual. The amount of supply chain disruption we had, pandemics so far have only come along once a century, and hopefully it'll be another century before we have another one. And we've also seen an unusual resilience, not only in the U.S. economy, but elsewhere, to very significant interest rate increases. And so that's a little bit off of the traditional playbook. Is it a whole new playbook? I'm not so sure yet.
Right.
But certainly it's pushed the existing playbook to the edges.
Professor Krosner, thank you so much. Randall Krosner, the former governor of the Federal Reserve System. Paul Sankey joins right now, founder and lead analyst at Sankey Research, with one of the most read notes on the street. Paul, I want to go to the madness of 1986. OPEC absolutely blew it in 1986 with a price plunge. Can we get a redux on that again, and particularly with the new American production of oil?
It's not 86, no. And by the way, it's a pump jack. And Lisa
Thank you, Paul.
should think about the joke that's kind of more realistic is you use your swimming pool to store oil, but you need contango. You need contango for that swimming pool trade, and we're in backwardation. So 86 not the right one to be honest, Tom. It's that was when OPEC increased into the Asian financial crisis, and it's quite the opposite here. What we've got here is the 2014. Probably not a 2020, but in both cases, that's where Saudi flushed the market, essentially because they got frustrated with cutting back production to maintain prices, such as 2014 being the really excellent example. What was happening is they were losing market share, particularly to Iran, which was coming back through sanctions. Mm-hmm. And you had, of course, the growth in U.S. production that was squeezing Saudi from the other side. And then in 2014, they essentially couldn't get the rest of OPEC to agree with them. They dumped the market. They flushed the market. We went in a straight line from 110 in summer to 50 by 2015 January. So in 6 months, we cut in half. And then we bottomed again, if you remember, in 2016. I don't think COVID, the 2020 market share war, which was more extreme, Saudi went to an all-time high level of production in 2020, which was in April 2020, which was truly praised in a lot of ways because, of course, it made for negative oil prices in the U.S. But here you've clearly got a situation where Saudi has cut production and is facing a very strong demand environment. So it must be extremely, and in fact, an all-time record demand environment. It must be very frustrating for them to be losing market share to Iran. And as John mentioned, to a absolutely booming U.S. industry. And I think everyone's turned negative oil, not least because the U.S. has accelerated this year into the second half in terms of production and, taken more market share from Saudi. So our concern is that Saudi said they'll push through Q1 with cuts, but by the time you get to Q2, and if demand isn't strong enough seasonally, you could see Saudi dump the market and try and make everyone honest again. I think that's the analogy.
Paul, I just want to be really clear about where we are right now. There's a lot of people trading equities, economists making recession calls. You think this is about supply and not demand right now, currently?
I don't know how you can get higher demand than all-time record demand. Now, having said that, because we're 102.5 million barrels a day, we're at over 1,200 barrels a second of demand. So I think the demand side's pretty much good. And China's been pretty good in the second half too, which was always the balancing item in terms of bullishness in oil. And keep in mind, of course, John, that it's seasonally a weak time for oil here. So we're dumping into, the traditional post-Labor Day weakness. And we'd actually think, whilst we're worried about the Saudi market share war, we can see a bounce here in oil. Distillate demand here remains very strong. It's cold this morning in Brooklyn, but more importantly, it's cold in Europe. And, I think we're a bit oversold in oil here. Doesn't change the fact that we think there's a structural problem in the market, which exactly as you say is too much supply and too much spare capacity particularly.
Well, but Paul, I want to just develop. You think that we're oversold here, and yet you think that there is a good chance that Saudi Arabia flushes the market, increases production, goes away from some of those cuts to, as you said, make everyone honest again. In that case, how low could prices go?
Well, it's an interesting question because what you're trying to do at that point is shut down U.S. supply growth. And that becomes the knotty debate. That's the analysis. That's the Permian question. Because, of course, what Saudi's trying to flush at this point is going to be Exxon, Chevron, Conoco. It's not your old school E&Ps with a lot of debt that kind of collapse at the first sign of trouble. And, of course, all these companies have basically planned at $60, maybe less, in terms of what they're doing and have growth targets that they want to meet. So I think it's going to be a more inelastic supply side for the Saudis to attack. Additionally, in 25, we're adding 8 FPSOs, that's a floating production and storage vessel, which are very big in places like Guyana, Senegal, and those are very price insensitive as too. That is to say, once you've built your huge production vessel, you don't shut it down because oil's at 50. So it's a fascinating market. And by the way, Tom, going back to 86, the whole peak oil question is like, what were you talking about? The supply side has got excess capacity at 102.5 million barrels a day of demand. It's like, what? I think a lot of it is technology and AI, actually, seriously.
Paul, I'm very proud to say I didn't believe in peak oil for 1 minute. That's maybe one thing I got somewhat right. Paul, we see Mr. Putin on a junket to Saudi Arabia with Mohammed bin Salman. What's the dynamic there? Do the Saudis tell the Russians what to do in the Paul Sankey world?
I think they ask them for help for sure. The problem is the Russians lie, right? I mean, whatever they say is like whatever they say. I don't know how much they really do. It's possible that they realize that there's enough of a problem and that they want that relationship with Saudi to be good, that they do get on board. And I think it is very significant, obviously, that Putin's meeting MBS, because there must be some quid pro quo here. We suspect, and we really don't know, that the Saudis have also asked the US to tighten sanctions on particularly Iran, but also Russia, obviously, because those have been two other major problems for the Saudis. The US has essentially been allowing a lot of additional oil onto the market into an election year. We think that maybe the Saudis have said, if you tighten sanctions, we'll make sure that the oil price doesn't get too high for elections. But of course, then the complexity is, do the Saudis really prefer Donald Trump? So, I'm not sure about that speculation, but certainly there's been evidence the US has been tightening somewhat the Iranian and Russian sanctions, which would help Saudi.
Paul, didn't they try that going into the midterms last year?
Try to tighten sanctions or try to
get the Saudis to boost output to get crude prices lower?
Yeah, I think Saudi-US relations have improved over the last year for sure, and I think through the Hamas, nightmare, we've seen obviously a lot of work from Blinken to try and get everyone back on the page. Now, of course, it's said in the press that the MBS actually kept Blinken waiting for quite a long time at a time when he was insanely busy, which I'm sure he didn't appreciate. So I think they're still sending messages that the original language of this administration, which you'll remember well before the election when Biden was very negative about oil and very negative about the Saudis, they don't forget that stuff easily. But at the same time, they're very pragmatic people. I think they realize that the US is hugely important to them. We've subsequently had security agreements between Saudi and the US. Yeah. So it's really complex, and I think a lot of people are saying a lot of things to there's a lot of multipolar world going on here. I don't know how much they really truly love the Russians as well. I mean, the history of that relationship is nothing like the quality of the history of the US-Saudi relationship.
Well said, Paul. Appreciate the explanations this morning. Thank you, sir. You're one of the best. Paul Sankey of Sankey Research.
joining us right now. Terry Haynes with Pangea, a really timely discussion here, staggering to January. Terry Haynes, the zeitgeist out there is OMG, a red nation, a Republican presidency, a Republican Senate, and now a Republican House, maybe not. Where are we heading here? Are we heading to a Republican sweep?
I think where we're heading is very much like what you see today, Tom, frankly. Whether or not the president is Democratic or Republican, I'd still give Biden in a Biden-Trump race, I'd still give Biden a little bit of edge. So let's start there. I think what you've got is a Senate that is more likely to be marginally Republican majority and a House that's more likely to be marginally Democratic majority. So it's another version of the same thing. People will spend the next year winding themselves up about this, but the reality in Washington is unless you have a sweep of all three parties plus a 60-vote majority in the Senate, which nobody's had for decades, not much changes.
Do you see a Trump-Haley ticket? I was asked at least 3 times this week about that. Is she running for vice president?
No, I think she's running for president, and and I think she's doing reasonably well, as I say, and as you all kindly headlined. 6 out of 10 Republican voters don't want her. Even in the Trump numbers in early primary states, 1/3 of those people at least are what pollsters call soft. In other words, willing to entertain other options. Iowa has a history of surprising. She's very much running for president and thinks that if a couple of breaks go her way, she might well get the nomination. And if that's the case, polls show today she'd do much better than Biden would do. So there's a path there for her, and she sees it and she's trying to seize it.
Can you develop a little bit more what that path is, considering the fact that Trump is still polling at about 60% of Republican voters, and she currently is at 15%?
Well, the path is this. Firstly, throw out the national number. At no point in the presidential race is a national beauty contest number ever relevant. It's all about getting the nomination. It's all about primary states. You get down to the primary states, Iowa and New Hampshire. Now Trump's at about 40 to 45, depending on the polls. So what you have is you've got 55 to 60% that already don't want Trump. 1/3 of those, as I say, are at least willing to entertain an alternative. So it doesn't take much to see the quick consolidation in the race that's already happened, combined with some Trump underperformance. Say, a lot of those people decide, what I heard from Christie's right. Trump's not really going to be able to govern or anything else, and make a break. All of a sudden, what you've got in the first race or two is you've got a real race where Trump looks like he's underperforming, and the not Trump field is coalescing. That's the race Haley sees. My only point is there's a much bigger chance of that than most people are willing to entertain, because I think, frankly, they're blinded by the national number.
In the meantime, Terry, there's this question around the ability to govern before that, especially heading into the new year, given the fact that Kevin McCarthy is going to be stepping down, the former House Speaker, who is going to leave at the end of this year. How much more likely, given the thin majorities, how much more likely does that make some sort of government shutdown?
I think marginally. I think there's a likelihood that what you see either in January or February from House Republicans is some sort of a shutdown. A lot of this, the vast majority of this, of course, is performative. They're wrangling over 30%, 1% cuts in 30% of the budget. So it's not as if they're taking an axe to anything. But what they'd like is some backtracking in spending, and you heard that from the presidential candidates last night, where Haley frankly proposed something return to pre-COVID levels than even House Republicans are doing. So they want a nod in that direction. But there's not a lot of meeting on the spending thing.
Terry, the middle of July next year, the Yankees are going to be playing .700 baseball with Aaron Judge and Juan Soto. I mean, it's a no-brainer right there. There's going to be a confab in Milwaukee, to the convention in Milwaukee, and frankly, the Democratic equivalent. Are these going to be normal conventions?
If Biden is the nominee, it's going to be a fairly normal convention. If Trump is the nominee in the Republican Party, I'd predict kind of mass defections and even a temporary split in the party as a lot of people walk out and refuse to support. Not unlike, in a very broad sense, not unlike what happened to Democrats in 1972, where a lot of the traditional Democratic coalition, including Labor, refused to support McGovern and instead supported Nixon. I think you see a lot of that stuff. The other great unknown between now and July is what happens with third-party races, whether it be with Bob Kennedy,
right,
whether it possibly be with Joe Manchin, somebody else. As I say, I think there's a huge restiveness in the electorate, and you could see a third-party candidacy
right,
gaining fire really quickly.
When do we see the machinery to have a third-party candidate? Is that a January event, an April event, or dare I say into the convention season?
I think more like a March to April event, frankly. That is kind of what the no labels people have promised. But more importantly, what no labels has promised is the idea that, look, once things begin to take shape and we know whether there's a Trump versus Biden likelihood or not, then we'll make a decision. So you're looking at Super Tuesday in early March, and after that, I think you probably get a decision.
Terry Haynes of Pangea Policy. Terry, thank you.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Lisa Abramowitz, and this is Bloomberg.